AT&T, stock ticker T, has seen a really nice jump up in its share price over the past 5 days after releasing their Q3 earnings report. You can see they're currently trading at $15.38 per share, and over the past 5 days, up 7.76%. Now, make no mistake, they are still down quite a bit year to date, around 17.93%, and over the past year, down around 8.12%. But in this video, we're going to be digging into their most recent quarter's earnings report, talking about why this share price jumped up so much, and jumping into my stock valuation spreadsheet to see if we can find the intrinsic value. So let's go ahead and jump into it. Now, trading at their current price gives them a starting dividend yield sitting right at 7.22%. So yes, still a pretty high starting dividend yield. Now, keep in mind, a few years ago, they did go through a dividend cut. They were paying out around 39 cents per share every single quarter, but in 2022, the dividend got cut down to around 28 cents per share. But that's something we'll come back and talk about a little bit later. Let's go ahead and dig into the earnings results. We can see right here, latest quarter's earnings. They released it on October 19th, and we saw a slight beat on the earnings per share normalized, and then the revenue was a beat as well. They were up around 117.14 million on the revenue. So that's kind of the surface level overview of their latest quarter's earnings report, but I want to dig into it a little bit more. So we are going to jump into their presentation. Now, there's a couple of things that I want to point out in this presentation, but the first thing is over here. We're looking at our business priorities for 2023, and they do talk about a few different things here that are probably worth noting if you want to pause the video. But what I really want to point out is where they talk about deliberate capital allocation. For the longest time, the biggest problem people have had with AT&T is how they properly allocate capital. For a long time, they were paying out way too much in dividends while not focusing on their long-term debt. And obviously, like I just mentioned, the end result of that was climbing debt levels, and this led to having to reduce their dividend, which we just pointed out just a few years ago. But we can see here, now they are investing for long-term growth, and they're looking to strengthen their balance sheet by reducing net debt and other liabilities, improving financial flexibility over time, and they're trying to do this while also providing an attractive dividend with improving credit quality. Now, since they cut their dividend payment, you can see they haven't been increasing their dividend payments any. It's been 28 cents per share every single quarter for around the past 6 or 7 quarters. But if we jump back over to the presentation and scroll down, we can see exactly where this growth was coming from. We can see when we compare where they were in Q3 of 2022 to 2023, they saw an increase in many areas. They saw an increase in postpaid phone subscribers, mobility service revenues, mobility EBITDA. AT&T fiber subscribers saw a really nice jump up, AT&T fiber revenues, as well as consumer wireline EBITDA. Now, the AT&T fiber revenues was a really nice jump up. They saw a 27% increase from Q3 of 2022 to Q3 of 2023, which is really in line with right where they want it to be. Scroll down just a little bit further, and the last thing that I want to point out is, yes, revenues was a slight beat. The adjusted earnings per share was a slight decrease, but overall, what I really want to focus on is the free cash flow for AT&T. Growing their free cash flow has been a little bit of a struggle for them over the past few years, but they saw a somewhat decent increase from Q3 of 2022 to Q3 of 2023. To touch on that free cash flow just a little bit more, we can see how they were through the first 9 months of 2022 versus the first 9 months of 2023. We can see cash from operations a decent bit higher in 2023 through the first 9 months compared to 2022, and free cash flow done a really good job of increasing year over year. You can see they're at around $8 billion through the first 9 months of 2022, but in 2023 they're already at $10.4 billion, and really they weren't projecting much free cash flow growth for the next few years. So this is a nice surprise and definitely added to the recent bump up in the share price that we've seen from AT&T over the past 5 days. Now let's go ahead and jump over to my stock valuation spreadsheet to see if we can find the fair value of AT&T and see if it's a stock we should consider buying. And like always, if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in the stock ticker T and hit enter, and you can see all this data will automatically load in. We've already touched on the dividend data a bit, currently yielding around 7.22%. Analysts have a target price of around $18.16, which is a decent bit higher than that current trading price. We can see institutional ownership actually pretty low, which isn't much of a surprise to me, at around 55.47% and a beta of just 0.63. So you should see very little volatility with this company. Now, like I mentioned, we already touched on the dividend yield, dividend payout, and the dividend history. They did see a dividend cut, but I want to look at that dividend growth rates and the dividend safety. Now, obviously, the dividend growth rates are going to be negative because of that dividend cut. So how safe is the dividend after the dividend cut? And if you know me, you know my favorite payout ratio to look at is the cash flow payout ratio, because dividends are paid out of free cash flow, and this will essentially show us how much of that free cash flow is being used to pay out dividends. Right now, it looks like they're actually in a pretty healthy range, sitting at around 20 to 21% free cash flow, depending depending on if you're looking at the trailing 12 months or the forward-looking cash flow payout ratio. So compared to where they were around 3 years ago, obviously the dividend cut looks like it was the right decision. Their cash flow payout ratio is much healthier, allowing them to do things like pay down more debt and potentially increase that dividend slowly in the future. But if we jump back over to my stock valuation spreadsheet, let's go ahead and look at our first valuation, which will be Graham's valuation. I'll zoom in here, and you can see the formula Benjamin Graham lays out for us to calculate intrinsic value right here. We plug in our earnings per share, our growth rate projection, which is still very low even despite the dividend cut, freeing up more free cash flow. And then we have our current yield on AAA corporate bonds. And at the time of this video, it's climbed up even higher since we last looked at AT&T. It's all the way up to 5.64. It continues to climb higher, which will push down this valuation by quite a bit. You can see it gives us an intrinsic value of $15.17 per share. Current economic conditions really pushing down this valuation for a lot of stocks. Keep in mind, just a few years ago, the current yield on AAA corporate bonds was sitting at around 3.5, which would push this valuation all the way up to $24 per share. So again, economic conditions definitely playing a large role in this valuation. Now, the next valuation we're going to look at is the discounted cash flow analysis. And typically when we do this, we look at the historical free cash flow, but remember they had that spinoff with Warner Bros. Media. So looking at the historical free cash flow really doesn't tell us a lot in this situation, but we do have the current year projections that management has given us for AT&T. And then based off of this, I'm going to stay in line with around analyst expectations of around 2.5% free cash flow growth, which does seem to be attainable based off what we've seen through the first 3 quarters of 2023. So I'm going with a 2.5% free cash flow rate moving forward, found the present value of those future free cash flows and added them together, added AT&T's cash and cash equivalents, and subtracted out their total debt, which is still a very large number, by the way. This gives us their equity value. We divide by shares outstanding and come to a discounted cash flow price per share of $15.74. Now, the next valuation we typically look at is the multiples valuation, but really Verizon's the only good comparable, I think, for AT&T. So we're not going to use it in this scenario because you typically want 3 to 4 comparisons. So that means the last valuation we'll look at is the dividend discount model. And this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. And like we've already mentioned, they did cut their dividends, so the historical dividend data really doesn't help us in this scenario. The current dividend payment is around 27.8 cents a share, meaning the yearly dividends is around $1.11. Now, the big question is, will they be able to increase this dividend? It's clear that right now, that's not something they're looking to do, but I do think in the future, once they pay down some debt, we could see dividend growth rates of around 1 to 1.25% moving forward. So with a 1% assumption and a discount rate of 8.5%, that gives us a dividend discount model price per share of $14.97. So when we jump over to the output tab, we can see the 3 valuations that we used, all pretty close. Graham's at 15.17, DCF at 15.74, and dividend discount model at 14.97. That gives us an intrinsic value of $15.29, very close to that current trading price. With a 10% margin of safety, you could see our acceptable buy price sitting at around $13.76, and with a 20% margin of safety around $12.24 a share. So obviously AT&T gets a lot of people excited because of that high starting dividend yield sitting at 7.22%, but I think there's probably better opportunities on the market where you can see more capital appreciation, and obviously something that I want to see is dividend growth, because if you want to be able to live off of dividend payments long time, dividend growth plays a large role in your ability to be able to do that. So again, if you're a long-term investor like me, there's probably better opportunities, but if you're someone looking for immediate dividend income, maybe this is something you should look into closer and see if it fits in line with your investment objectives. But there you go, there is a quick analysis on AT&T. Go ahead and let me know in the comments down below what you think of this company. If you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. You can also get a coupon to Seeking Alpha for $50 off and a 7-day free trial at my link in the description, so be sure to check that out. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.